Hey everyone, welcome back to Corporate Decoder, the place where we break down the nitty-gritty of company filings and try to make sense of what they mean. Sometimes with a bit of a smirk. Today we're diving into Ascend Wellness Holdings Inc. Its latest quarterly report, and let's just say there is a whole lot of numbers in here, some good, some well. You'll see before we get into the weeds, if you enjoy these deep dives into what companies are really saying in their official reports, do me a favor and hit that subscribe button. And hey, we have a growing community over on Discord, linked in the description below, where we break down these filings even further. It's a great place to connect and ask questions. Now, let's see what Ascend Wellness Holdings has been up to. Alright, so this is Ascend Wellness Holdings, or AY Inc.'s quarterly report specifically for the period ending the 30th of September 2025. Think of it as a snapshot of their financial health over the last 3 months and first 9 months of the year. Let's kick things off by looking at their balance sheet. At the end of September 2025, Ascend had about $87 million in cash. That is down slightly from the end of 2024, but still a solid chunk of change. They also have around $82 million in inventory on hand. This is basically the product they have ready to sell, and it is down a bit, which could mean they're managing it well or perhaps selling it off to free up cash. Now, property and equipment, that is buildings, machinery, that sort of thing, this number has gone up significantly to nearly $289 million from around $260 million. This suggests they're investing heavily in their facilities, likely to expand their operations, which is a big deal for a company in the cannabis space. When we look at liabilities, accounts payable and accrued liabilities were about $58 million. That is payments they owe to suppliers and for other short-term expenses. This is also down a bit, which is generally a good sign, meaning they are likely paying their bills on time. Here is a big one, long-term debt. This has jumped from about $234 million at the end of 2024 to over $343 million by September 2025. That is a substantial increase, indicating they've taken on more debt, likely to fund those investments we saw in property and equipment and other expansion efforts. This is definitely something to keep an eye on. Looking at stockholders' equity, the additional paid-in capital is fairly stable at around $471 million. This represents the money investors have paid for stock above its par value. But here is that familiar story for many growing companies, an accumulated deficit of nearly $470 million. This means, over their lifetime, they've spent more than they've earned. It's a classic sign of a company prioritizing growth over immediate profits. Now, let's sift through the income statement. For the 3 months ending the 30th of September 2025, revenue was about $124.7 million. That is a pretty noticeable drop of almost $17 million, or 12% compared to the same period in 2024. The report says this is due to increased competition and pricing pressure in most of their markets, especially in Illinois and New Jersey. Cost of goods sold also went down by over $16 million, which makes sense since they sold less. Interestingly, even with lower revenue, their gross profit percentage actually improved to 35% from about 31% a year earlier. This means they are becoming more efficient at producing or acquiring the goods they sell, even if overall sales are down. They mentioned better production output and a higher volume of their own branded products being sold through their stores helped here. General and administrative expenses, what it costs to run the company day to day, went down by about $1.2 million. They specifically mention lower professional services fees and the absence of a prior year reserve for a long-term receivable. That sounds like they're tightening the belt on some costs. Despite the improved profit margin and lower administrative costs, they still reported an operating loss of about $1.3 million in this quarter. It is an improvement from the prior year's loss of $2.4 million, but still a loss. Interest expense also decreased by about $3.9 million, even though they took on more debt. This might sound confusing, but the report explains that the previous year had a significant loss on extinguishing debt, which inflated that number. The new debt, while larger, has a slightly lower interest rate overall, and they seem to be managing the interest payments better this quarter compared to the prior year's one-time extinguishment costs. All in all, the net loss for the quarter was around $25.8 million. That is actually a bit better than the $28.2 million loss they had in the same quarter last year. Now let's look at the bigger picture, the 9 months of operation. Revenue here saw a larger drop, down by about $45.5 million or 11% compared to the same period in 2024. Again, this is attributed to challenges in legacy markets and increased competition. Their gross profit percentage for this 9-month period stayed relatively stable at around 32.8% for 2025 compared to 32.3% in 2024. So their ability to turn sales into profit at the product level remains pretty consistent. Here is a positive trend. General and administrative expenses for the 9 months dropped by over $14 million. A big chunk of that was lower equity-based compensation expenses, and they also did not have that large reserve for a receivable that they had last year. This shows a real effort to control overhead, and this cost control is paying off. They went from an operating loss of $1.3 million for the first 9 months of 2024 to a small operating profit of $159,000 in the same period of 2025. That's a significant turnaround, moving from the red to the black, even if just barely. Despite that operating improvement, the net loss for the 9 months actually increased slightly to about $69.5 million from $68.2 million. The main culprit here is an increase in interest expense, likely due to that growing long-term debt we saw earlier, and also income tax expenses which oddly went up, probably due to specific tax laws impacting cannabis businesses. They also provide these non-GAAP measures which are important for understanding their operational performance. Looking at adjusted gross profit, which essentially backs out some non-cash charges, it was about $57.8 million for the quarter, up from $53.5 million last year. Their adjusted gross margin also jumped significantly to 46.4%. This really highlights their improving efficiency at the operational level, separate from some of the accounting adjustments. And then there is adjusted EBITDA, a measure of profitability before interest, taxes, depreciation, and amortization. For the quarter, it came in at about $31 million, up from $25.1 million last year. This is a strong indicator that their core business operations are becoming more profitable. The adjusted EBITDA margin improved to 24.9% from 17.7%. This is a really positive sign, showing they are becoming much more efficient at generating earnings from their sales, even if overall revenue is down. Let's talk cash flow. For the first 9 months of 2025, they generated about $21.7 million in cash from operations. That is down from $38.1 million in 2024. This decrease is mainly due to higher cash interest payments on their debt. In investing activities, they spent about $29 million in 2025, similar to the previous year. This is consistent with that increase in property and equipment we saw earlier, meaning they are spending money to build out their operations. Financing activities are where we see big shifts. In 2024, they used about $15.3 million, largely for debt repayment. But in 2025, they actually provided about $6.2 million, which includes money from new debt like that mortgage note, partially offset by debt prepayments and share buybacks. This suggests they are actively managing their debt structure and raising new capital. Looking at contract obligations, their term notes alone total $300 million due in 2028 and 2029. That is a large bill coming due, and the fixed interest on those notes is over $153 million. Then you have operating leases, which represent future payments for things like rent on their stores and facilities. These commitments are massive, over $596 million. Plus, finance leases add another $72 million. It is clear they have significant long-term financial commitments. Now, let's touch on the risks. The report lists a ton of them, which is typical for this industry. They worry about the volatility of their stock price, the legality of cannabis under federal law, banking access, marketing constraints, and unfavorable tax treatment. AAAOY Inc. is dealing with a very complex and evolving legal and regulatory landscape. They also mention ongoing legal battles. The one with Medman is particularly interesting. Ascend won a default judgment for over $10 million related to a deposit and advances on a working capital loan. However, Medman has filed for bankruptcy, so collecting that judgment might be another challenge entirely. This highlights the financial risks and complexities of deals in this industry. And speaking of complexity, the income tax situation for cannabis companies is just wild. Because cannabis is illegal federally, companies can only deduct expenses directly related to selling products. This means many normal business expenses aren't deductible, artificially inflating their taxable income. Ascend has a massive uncertain tax liability of nearly $187 million, indicating they are contesting many of their tax positions. This is a huge financial overhang. So, what is the story here for Ascend Wellness Holdings? On the one hand, their operational efficiency seems to be improving. Their adjusted gross profit and adjusted EBITDA margins are showing solid gains, demonstrating better control over their core business and a more profitable product mix. They're also showing some success in managing general and administrative expenses. However, the company isn't out of the woods yet. Revenue is declining, which is a major concern, and their long-term debt has ballooned. While they are investing in future growth through acquisitions and capital expenditures that increase debt, and those significant lease and contractual obligations do pose a risk. especially given the ongoing legal and regulatory uncertainties in the cannabis industry. The fact that they still have an accumulated deficit and are reporting net losses despite improved operational metrics means profitability is still a key challenge. The substantial tax liabilities and the ongoing legal battles, like the one with Medman where collecting on a judgment could be difficult, add layers of financial risk. They are navigating a very tricky path, balancing growth ambitions with the need for profitability and managing significant financial and regulatory hurdles. Ultimately, Ascend Wellness Holdings appears to be in a period of strategic investment and restructuring. They are making progress on efficiency and operational improvements, but the declining revenue and increasing debt are serious red flags. The future will depend heavily on their ability to turn those operational gains into overall profitability and to successfully manage their debt obligations in an increasingly competitive and legally ambiguous market. Alright, that is our breakdown of Ascend Wellness Holdings' latest financial filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.